So hello everyone, my name is Aakash Kandoi and I teach CA Final Financial Reporting subject at Unacademy. So first let me tell you about some offers. Unacademy has come up with an offer where if you buy any Unacademy subscription between these dates, October 11 to October 14, you will get 20% off on all Unacademy subscription. You can use code FR with AK to avail this offer, right? Apart from this, if I tell something about myself, my name is Aakash Kandoi. I am a chartered accountant. I have also done a diploma in IFRS and also a CFA Level 3 Candidate. So I teach the subject of financial reporting and try to make it easy for you. That is why we say hashtag FR with AK or hashtag FR made easy with AK, right? So on Unacademy, we have two types of subscription. One is Plus and one is Iconic. In Plus, you will get access to the lectures. In Iconic, you will get the hard copy as well. But in Iconic, you won't get my hard copy, but you will get a hard copy of other faculties, right? So you can use code FR with AK to avail 20% off on all these Unacademy subscription plans. Apart from this, you can watch Unacademy's free special classes where you will earn credits and you can use these credits to redeem while buying the Unacademy subscription, right? Also, this is our CA Final Unacademy Dream Team, and these are the details of my lectures, right? On Unacademy, we have one comprehensive batch which is approximately going to be of 220 hours, and also we have a fast track batch. The approximate duration will be approximately 120 hours, right? So you can enroll for that batch as well. So thank you so much everyone for listening. Now, today in this session, we are here to revise three topics: IND AS 1, IND AS 16 and IND AS 38. These three topics will be revised in 100% English. So for those students who are here to revise these topics, please remember this lecture is going to be in 100% English, right? PDF I won't be able to provide because of copyright issue. Second thing. Third thing, if you want to refer my Hindi lectures, they are already available on Unacademy's YouTube channel. So you can search that particular topic and type my name and you will get that lecture. So here our motive is to conduct these sessions for those students who are not very much comfortable with Hindi or with English. So this three revision sessions are going to be in 100% English. First thing. Second thing, we will be revising all the concepts of these three topics, right? So question revision we have already taken on YouTube. So we will revise only the concepts because initially we need to focus more on concepts and then we can take forward with the questions. So in another session, we might be able to take up certain questions as well. So here we are going to revise all the concepts. Thank you so much, Govind Singh, for your kind feedback. Okay, chalo. So here we are and we are going to start revising first of all IND AS 1, and we are going to start in 3, 2, 1 and go. First of all, IND AS 1, presentation of financial statements. Ideally most of the students tend to skip this topic, but in these topics only three particular concepts are important, right? The first concept which is important is the definition of current asset, right? The definition of current asset. The second concept which is important is definition of current liability, and the third concept which is important is breach of long-term loan arrangement. So you need to remember only these three concepts. You need to revise only these three concepts in IND AS 1. So let's briefly revise all the three concepts. First, definition of current asset. In this definition, we ideally have four conditions, out of which any one is to be met. If any one is met, it will be a current asset. Now, the first condition is it should be expected to be realized or consumed within the operating cycle. What is an operating cycle? From the moment where you buy your raw materials, then you convert it into FG and then you sell it and then you realize money from debtors. This whole circle is known as operating cycle. So if you tend to realize your money within the operating cycle period, it will be a current asset for you. First condition. Second condition, yes, it will be available later. Second condition, if it is expected to be realized in 12 months from the end of reporting period. Let's say you have certain amount of money to be received from a third party, and if you feel that if it is expected that it will be received within 12 months, but 12 months from which date? 12 months from the year end, from the reporting period, right? So if you feel you will be able to receive those money in 12 months from the end of reporting period, you can classify that particular item as current, right? The third point is if it is held for trading. So what is an example of held for trading? It can be an inventory for you, right? And the fourth point, if it is cash and cash equivalent. So example can be cash balance, bank balance. And what is the meaning of cash and cash equivalent? Any amount of money which is receivable within 3 months, any amount of short-term securities which can be realized into money within 3 months, is known as cash and cash equivalent. So if it is cash and cash equivalent, it will be classified as current asset. But there is one exception here. The exception is unless it is restricted of being exchanged or used for settlement for at least 12 months from the reporting period. Now, what is the meaning of this? If there is any cash and cash equivalent which has a restriction on it, what type of restriction are we trying to discuss? Let's take, for example, we have a savings bank account. We have a savings bank account which has been seized by the government for at least a period of 2 years. Let's say for a period of 2 years. So can we say that I cannot withdraw any money from this savings bank account for at least 2 years, right? So they are trying to say, if there is any restriction on a cash and cash equivalent for at least 12 months from the end of reporting period, that means if you cannot use this money for at least 12 months from the end of reporting period, then it will not be classified as current. That means this is an exception. That is why it says if it is cash and cash equivalent, then it is current, unless, that means there is an exception. If this exception is met, it won't be classified as current, right? So these are the 4 points which you need to remember. If any one condition is met, you will classify the asset as current. I hope this is clear to everyone. If you are able to understand this, can you tell me in the chat box yes or no, so that I will be able to understand whether you are able to get these concepts or not. Please type in the chat box if you are able to understand these concepts. We are here to revise, so I'll try my best to make you revise in a much easier manner. Yes, perfect. So we are good to go. Yes, chalo. So we are good to move ahead. So this was the first concept which is important from exam point of view. What about the next concept? The next concept is the definition of current liability. Even in current liability, we have 4 conditions. Out of 4, any one is to be met. The first condition is going to be if it is expected to be settled in operating cycle. Again, the same. Only difference between current asset and current liability is above we had to realize that money. Here, it is expected to be settled. That means we have to pay the money here, right? From the point of view of liability. So if it is expected to be settled in operating cycle, then it will be current liability. Or if it is due to be settled in 12 months from the end of reporting period, then it will be current liability. There is one terminology which you need to remember. Here the word is due. In current asset, the word was expected, right? Now, what is the difference between due and expected? Please remember, I'll try to explain this with the help of an example. Let's say, for example, I had to make a certain payment through a trade payable within 6 months, right? So it is due within 6 months, but Aakash Kandoi being himself, he knows that he won't be able to make this payment within 6 months. He will make this payment after 24 months. So he has an expectation that he will not pay within a period of 12 months. So in case of liability, the expectation won't be considered. When it is due, it will be considered. That means if it is due to be settled within 12 months from the end of reporting period, it has to be classified as current, irrespective whether you expect it to be paid or not, right? This was the second condition. The third condition is if it is held for trading. So what is the example of held for trading in case of liability? Many financial institutions trade in futures and options. So if that future and option is a loss-making instrument for you, it will be classified as derivative financial liability. So such derivative financial instruments can be held for trading in case of liability. The fourth condition is if it does not have an unconditional right to defer the settlement for at least 12 months from the end of reporting period. Now, what is the meaning of this point? Let's try to understand this with the help of an example. Let's say, for example, you have a certain liability which has to be repaid within 6 months, right? Let's say the other party has given you an option, an unconditional right that you can defer this for a period of 3 years. If you have such deferment right, then it will be non-current. But if you do not have such deferment right, then can I say that you have to pay this within a period of 6 months? That means it will be current. So now let's try to read what are they trying to say. If it does not have an unconditional right to defer the settlement, if we do not have any such right, it will be current. If we have a right to defer it, then it will be non-current, right? So these are the 4 conditions under current liability, right? So if any one is met, we can classify it as current. So first definition was current asset, next definition was current liability. The next point which is important in IND AS 1 is breach of long-term loan arrangement, right? Now, what is the meaning of this breach of long-term loan arrangement? Let's try to understand this point with the help of one example. Let's say I have taken a 10-year loan. I have taken a 10-year loan. That means it is a non-current liability for me. I have taken this loan on 1st April 2022. Now, let's say there is one condition attached that till 15th March 23, promoters have to contribute a certain amount of money. If the promoters fail to comply with this, the loan becomes repayable on demand, right? That means in short, the loan will be classified as current, right? So if you do not fulfill this condition, this will be called as a breach, right? So if the company breaches this condition, the loan should be classified as current. So if I ask you on day one whether the loan will be current or non-current, so you will say it will be non-current. So remember one thing, until the breach has happened, the loan will be non-current. So even if I ask you on 14th of March, let's say I'm asking you this question on 14th of March, whether should I classify this loan as current or non-current, you will say non-current because till now the breach has not happened. Let's say for example on 15th May, we breach this condition. We are not able to bring the desired amount of money. So 15th May onwards, this loan will be classified as current. So once the breach happens, you will classify the loan as current, right? This is the first thing. This is the first scenario. Now, let's say once we breach, we ask for a grace period from bank, right? Let's say we ask for a grace period that please bank allow us some time so that we can get this promoter's contribution. So let's say bank grants you a grace period of less than 12 months. Less than 12 months from reporting period. So if we count from the year end, we are getting a grace period but which is less than 12 months. So in that case, on year end, the loan should be classified as current or non-current. So in this case, the bank clearly says that. So IND AS clearly says that if the grace period is of less than 12 months from the end of reporting period, it has to be classified as current. So what if the grace period is exactly 12 months or more than 12 months from reporting period? So if you are granted a grace period of more than 12 months from the end of reporting period or exact 12 months, then the loan has to be classified as non-current, right? So these are the three conditions which you need to remember. I'll summarize this again. First, if there is any breach, it becomes current. Until the breach has happened, it will be non-current. Let's say after the breach, you are granted a grace period of less than 12 months, current. After the breach, if the grace period is granted of more than 12 months, non-current. Now, the last condition. If in anticipation of the breach, that is before the breach has happened, that is on let's say 10th of March, before the breach has happened, I went to the bank for a grace period and I got a grace period of 3 months, right? So what is to be done on year end? What will be the classification on year end? Now please remember, if before the breach has happened, we went to the bank for a grace period. So in this case, the breach has not yet occurred. So since the breach has not yet occurred, even if the grace period is only of 3 months, still on year end, it will be non-current. Why? Basically, you will have to say that the loan will retain its original classification because the breach has not yet occurred. Since the breach has not yet occurred, it will be classified as non-current. You need to remember this. I hope you are able to understand these concepts. So these concepts relate to IND AS 1. These are the three concepts which you need to keep in mind. If you are able to cover these three concepts, your IND AS 1 is sorted. Now, after IND AS 1, the next IND AS which we are here to revise is IND AS 16. Please remember, in IND AS 1 there are other concepts as well. If you want to give it a read, you can give it a read. But from exam point of view, three concepts are important which I already mentioned. Now, after IND AS 1, we move on towards IND AS 16, and that is property, plant and equipment, PPE, right? So let's try to understand the concepts of PPE. The first point which you need to understand is the definition. In PPE, we have two definitions. The first definition relates to PP, right? It means tangible item held for use and expected to be used for more than one period. Because it has a life of more than 1 year, that is why it is going to be a property, plant and equipment. The next point is bearer plant. Now, what is the meaning of bearer plant? So first, to understand bearer plant, we have to understand one concept. There is something known as biological assets, which we study in IND AS 41 agriculture, right? So biological asset can be classified into two parts. One is living plants and one is animals. So generally our parents feel we are biological assets since they treat us as animals, right? So in case of living plants, there are again two bifurcation. Any plant which has a life of more than 1 year is known as bearer plant, right? And any plant which has a life of less than 1 year, it is known as non-bearer plant. So these biological assets and animals, these two things are covered under IND AS 41. But this bearer plant is covered under IND AS 16. Why? Because let's say for example we have a bearer plant which is a mango tree. Now mango tree has a life of more than 1 year. That means it is going to give mangoes for more than 1 year. So for a farmer, this mango tree is very much similar to a machinery. So like a machinery gives us output for more than one period, this mango tree will give mangoes to the farmer for more than one period. That means this bearer plant is like a machine for the farmer. That is why the bearer plants are covered under IND AS 16, right? So let's see the definition of bearer plant. It is living plant used in the production or supply of agriculture produce, expected to bear produce for more than one period and has a remote likelihood of being sold as agriculture produce except for incidental scrap. That means, what is the meaning of this point, has a remote likelihood? That means you are not going to sell the mango tree. You can sell the mangoes, of course. In case of PP, we are not going to sell the machinery, but of course we will sell the output which we realize from the machinery. In the same case, we won't be selling the mango tree. We can sell the mangoes as well, right? So the bearer plant will be covered under IND AS 16. As soon as we studied definition, we move on towards the second point, which is the recognition criteria. When will you recognize any PPE? When two conditions are met. The first condition is future economic benefit, and the next condition is if its cost can be measured reliably, right? Now there is certain guidance which has been provided in case of certain items. The first guidance which is provided is related to spare parts, standby equipment and servicing equipment. Whether if you have any spare part or standby equipment, should you classify it as PP? Let's say for example, I have a mobile phone, right? So most of my work is done through this phone. So I also have a spare mobile phone. So in case if this mobile phone is not working properly, I will use that spare mobile phone. So will that spare mobile phone will be classified as PP or not? So the standard says it will be treated as PP if the definition is met. In my case, to be precise, it should be treated as PP because I'm not selling it, right? I'm not using it currently, but I've kept it for using it in case of emergency, right? So it should be classified as PP. If you feel it does not meet the definition of PP, you can also classify it as inventory. Okay. Next point, aggregation of individually insignificant items. You might have certain insignificant items which individually are insignificant. Let's say for example, I have a mouse, I have a keyboard. This is individually insignificant, but if I combine all these items, it can be a material item, right? So can we aggregate, can we combine these individually insignificant items? Because on aggregation, on combination, they can be significant. So standard says there is no problem, you can definitely aggregate individual insignificant items. The third point is safety and environmental equipment. Whether such safety and environmental equipment should be classified as PPE or not. So the standard says these environmental equipments do not result in any direct output, but definitely they assist your other PP to achieve their output. Why? Because let's say for example, government has a regulation in your locality that if you don't install this pollution control equipment, you will have to pay a certain penalty. So that means this equipment is assisting other PPs to achieve their output. So because they indirectly assist other assets, therefore it will be classified as PPE, right? Okay. So this was the guidance note which was provided. Now let's move on towards the measurement criteria. So under IND AS 16, the first point which we studied was definition. The next point which we studied was recognition criteria. The next point which we are going to discuss is measurement. So measurement can be classified into two parts. One, it can be initial measurement. The other, it can be subsequent measurement. Now what is the meaning of initial measurement? Initial measurement means on day one, how will you classify this PP? How will you record this PP at what amount? That is initial measurement. And what is the meaning of subsequent measurement? At every year end, at what amount will you record this PP, right? So let's revise this first, initial measurement. Always remember, initial measurement will always be at cost, right? So now PP can be acquired in many ways. First, it can be purchased. Second, it can be self-constructed also. Third, it can be acquired by way of exchange like a barter transaction. And fourth, it can be acquired by way of government grant. So first, let's try to discuss about what if we purchase this PP. What will be the measurement of PP if it is purchased? So first of all, if you purchase a certain property, plant and equipment, what will be the components of cost? First will be purchase price less any trade discount and rebates. Next, any non-refundable taxes. That means any refundable taxes are to be excluded. So non-refundable taxes, see, all the directly attributable expenses, which includes these following items like employee cost, cost of site delivery, installation, cost of testing, right? But while testing, there can be a scenario where while conducting a test run, you might earn certain income from that testing proceeds, right? So if you earn any temporary income while testing, you need to deduct such income from the cost of testing, right? Professional fees and borrowing cost if it is a qualifying asset, right? These are the directly attributable expense which can be included, but the following things are not to be included. The examples are given as follows: inauguration expense, advertising expense, promotional cost, training cost, admin and other general overheads, initial operating losses. These are the items which you need to exclude, which you need not consider while calculating the cost of the asset. Apart from this, if you receive any cash discount, it should be transferred to profit and loss. One important aspect which you need to remember is, if there is any cost of decommissioning. What is the meaning of cost of decommissioning? Any direct expense for the asset which is not to be incurred today, but it is to be incurred after a certain number of years, right? For example, let's say if you wish to install a PP at a certain locality for a certain number of years, and after that completion of tenure, you need to restore that site where the PP was installed. That is cost of restoration and decommissioning. That means if you refuse to restore the site, you won't be able to install the PP and extract benefits out of it. That means that restoration cost is compulsory. So in this case, the restoration cost is a direct expense, but it is not to be incurred today. It is to be incurred after a certain number of years. That means we have to include that cost in the cost of PP, but such expense will be included at present value, which is because it is not to be incurred today. It has to be incurred after a certain number of years. That means such cost of decommissioning will also form part of your purchase cost, right? Now, because you have recorded such decommissioning cost at present value, every year end you will have to do a certain unwinding. What is the meaning of unwinding? Taking the present value towards the future value. So every year you will do some unwinding. But how do we record such amount? How do we calculate such amount? So let's say, for example, there is a decommissioning cost of 10 lakhs at the rate 10%, which is to be incurred after 5 years, right? So what will be the present value of this amount? So if I calculate 10 lakhs divided by 1.10, 1, 2, 3, 4, 5, the present value which is to be added in the cost of PP will be 6.21 lakhs, right? So the entry for this present value will be PPE to provision for decommissioning. Okay. Now, once this is recorded at present value, you have to do unwinding of this amount at each year end. So at the end of year 1, how will you calculate the amount of unwinding? So we have to prepare a small table. Year 1, what is the opening balance? 6.21. What is the interest at the rate? 10%. So it will be 0.62, right? What will be the closing balance? It will be 6.83, right? So this is the amount of unwinding. Unwinding is a process of bringing the present value towards the future value, right? So you will record that unwinding. At how will you pass the entry? It will be interest to provision. The amount will be 0.62, 0.62. Let's say, how will we calculate the unwinding expense for year 2? It will be, let's say this closing becomes the opening for next year. The interest will be 0.68 in this case now. So plus 10% if you do, it will be 7.51. I hope you're getting this point. So you will initially record this decommissioning in the cost of PP at present value, and then the unwinding is not added to PP. It is transferred to interest, profit and loss account. Okay. Okay. So this was the first point which you need to consider if the asset is purchased. There is one more point which is deferred consideration. Let's say, for example, if you are not making payment for any asset on day 1, if you are promising to make a payment, let's say after a certain number of years, the other party will charge you interest for delayed payment. Such interest will not form part of your cost, right? So that is the meaning of deferred consideration. So in case of purchase, we already discussed. What if we self-construct the asset? It will be same like purchase. the only thing which will come here is IND AS 23 borrowing cost if it is a qualifying asset, right? So now, what if the asset is acquired by way of exchange? What is the meaning of exchange? It means a barter transaction. Let's say I am acquiring a machine. Let's say my acquired asset is machine, and what I'm giving up is my furniture. So furniture is a given up asset for me, and what I'm acquiring is machine. So how do I record this transaction? So first of all, what is the asset acquired? Machinery. So I will debit machinery account to furniture account, right? This will be my journal entry. Now, the asset which is given up will always be taken out of your books at carrying amount. So this will go out at carrying amount. Now, what do we do regarding this acquired asset, right? So this, to record this acquired asset, at what value shall we record this acquired asset? So you can have three preferences. The first preference will be given to fair value of asset given up plus cash paid if any. So let's say while giving up any asset, you also paid some cash. So that can also be included. If you do not have this amount, the second preference will be fair value of asset acquired. If you do not have fair value of any of these, you will record it at third preference, that will be carrying amount of asset given up plus cash paid if any, right? So these are the three preferences which you can use to record the incoming asset. So this was the concept in case of asset acquired by way of exchange. What if you acquire any asset by way of government grant? It is discussed under IND AS 20, so it is not covered here, right? So this was the case of initial measurement. So if you purchase any asset, at what value will you record that asset initially, right? Now let's discuss about subsequent measurement. Now what is the meaning of subsequent measurement? At every year end, at what value will the asset be recorded? So in case of subsequent measurement, we have two models. One is the cost model, the next one is the revaluation model. Now under cost model, what do we do is we keep the asset at day one's cost less any depreciation till date, which is known as accumulated depreciation. And if you are aware about impairment, we will also less impairment losses. So in cost model, it's very simple, it's very basic. You record it at day one's cost and depreciate that asset for a certain number of years. That is the cost model. But what if we want to use the revaluation model? What is the meaning of revaluation model? That means you wish to bring your PP towards fair value. You wish to record your PP at fair value. Let's say you bought that PP for 10 lakhs. Now at the end of year 1, the fair value is 12 lakhs. So you want to record this PP, you want to keep this PP in your books at 12 lakhs. So how do we do the accounting? So this is known as revaluation model. So under revaluation model, you have 5 points to be discussed. The first point is, what is the frequency of revaluation? Like in how many years we have to keep on revaluing the asset. So if the changes in the asset's fair value is significant and volatile, you need to do the revaluation annually. But if the changes are insignificant, you can do the revaluation once in every 3 and 5 years. The next point is, what will be the treatment of accumulated depreciation on date of revaluation, right? So I'll try to revise this to be precise with the help of one example. So let's say, for example, you had an asset with a gross block of 100, right? Life of 5 years. What is the meaning of gross block? The value at which you initially bought the asset. Let's say you used the asset for a period of 2 years. So what will be the accumulated depreciation? What is the meaning of this point? Accumulated depreciation means depreciation till date. The date when the asset was bought and today. Till date, what is the depreciation? Accumulated depreciation. So let's say we used it for 2 years. So it would have been 40. So what would have been your net block? Net block means today's carrying amount. It would have been 60, right? So let's say today's fair value is also given, which is 90. Okay, which is going to be 90. Let's not take 90. Let's keep it simple. Let's take it 80. Okay. No, not 80. Let's take it 75. Okay. So what is our fair value gain? Fair value gain is 15, right? Because we wish to keep our asset at fair value, that means we want to follow revaluation model. Now, when you are following this model, what will be the treatment of this accumulated depreciation? What is to be done with this depreciation? So to treat the depreciation, we have ideally two methods, right? You can eliminate this depreciation, or if you wish, you need not eliminate this old depreciation. right? So we will revise these two methods in detail. So if you wish to eliminate this depreciation, what will be the accounting entry? So it will be eliminating the depreciation account debit to gross block. You will eliminate it against the gross block, that is 40/40. That means now your net block and gross block are again 60, and then you will record your gain, that will be PP to revaluation gain 15 and 15. That means you have eliminated the old depreciation as per the old cost. This is the first method. The second method is, if you wished to not eliminate this depreciation, then we have to follow three steps. Three steps are to be followed. The first step is going to be finding the percentage gain. How will you compute this gain? Your fair value gain divided by the carrying amount, that is 60, that way into 15, that will be equal to 25%. In the next step, you will apply this gain on two amounts. The first will be the first will be gross block, and the next one will be accumulated depreciation, right? So if we apply it to gross block, it will be 100 into 25%, that will be 25. And if you apply it to depreciation, it will be 40 into 25%, which will be 10, right? So you apply this percentage to two amounts, gross block and depreciation. Under the third step, you increase the gross block and depreciation by this amount. So if I want to increase the gross block, I will debit it, that is gross block account debit 25 to depreciation 10. By default, your balancing figure will be your revaluation gain. That means under second method, we are increasing the gross block and depreciation equivalently to record this fair value gain, right? So these are the two methods which you need to follow to record the accumulated depreciation on date of revaluation. Now, the next point, the next concept under revaluation model is that revaluation should be applied to entire class of asset. What is the meaning of this point? This point simply means that, what is the meaning of one class of asset? Any asset which have, let's say, the same characteristics. So asset having similar characteristics are to be valued at same method, right? Let's say, for example, I have 3 laptops. So if I want to follow cost model, I need to apply cost model on that entire class. If I have, let's say, 5 computers, so I do not have the option to apply fair value model to 2 computers and cost model to 3 computers. That is not the option available. So if you have a same class of asset, same model has to be used. Now there is one clarification which is provided under this point, that office building and industrial building are two different classes. Just because they both have building in their name, that doesn't mean that these are the same class. The nature is different, right? Same nature, same characteristic, that means same class. The nature of industrial building is different, the nature of office building is different. That was, these will be treated as different class of assets, right? Okay. Now the next point, the important point, this is very important, okay? And that is treatment of revaluation gain and losses. So once you revalue the asset, what will be the treatment of this revaluation gain and loss? First, if you are revaluing the asset for the first time, and if it results in a gain, such gain will be classified to OCI. If you are revaluing the asset for the first time and such revaluation results in loss, such loss will be transferred to profit and loss. What about subsequent revaluation? If you are revaluing the asset for the first time, then we already discussed, but if you are revaluing the asset subsequently and it results in a revaluation gain, in such case, such gain will not be directly transferred to OCI. You need to check whether you have any pending balance of previous gains or losses. So let's say subsequently it results in a gain, and previously also you got a revaluation gain. So such existing gain will also be transferred to OCI. But let's say subsequently it results in a gain, but previously you have a balance of revaluation loss. So first, such gain will be written off against the losses. That means first, to the extent of previous loss, such gain will be written off in P&L. So let's say, for example, you get an existing gain of 100, but previously you got a loss of 70. So out of this 100, the gain of 70 will be transferred to profit and loss, which will write off your previous losses. And the remaining balance 30 will be recorded in OCI. The same logic applies to losses. If you get a loss subsequently and previously also you had a loss, such loss will be transferred to P&L. But if you get a loss subsequently, but initially you had a gain, so first such loss will be applied to the gain, that is first To the extent of previous gains, such loss will be transferred to OCI. Balance, if any, it will be transferred to profit and loss. So this concept you need to remember. Okay, this was the treatment of revaluation gain and losses. Now, the next point is transfer of surplus to retained earnings. So as we book revaluation gain in OCI, such gain is accumulated in other equity under the head of revaluation surplus. So what will be the treatment of this surplus? When do we transfer this surplus to retained earnings? When do we transfer this surplus to retained earnings? So there are two scenarios here. First is a compulsory scenario. That means when the PPE is disposed or derecognized, that means when you sell the PPE or when the life of the PPE is over, at that point of time, full balance of surplus has to be transferred to retained earnings. First thing. Second thing, the second scenario can be excess depreciation. What is the meaning of this point? So let's say, for example, you revalue asset. Let's say you had an asset of gross block 100, life was 5 years. So you depreciated it for 1 year. So 1 year depreciation will be 20. So carrying amount is 80. Let's say fair value is now 90. So what is your revaluation gain? It will be 10. What will be your revised carrying amount? It will be 90, sir. Okay. What is the remaining life year? It will be 4 years. Okay. So what will be the depreciation now? So we will do 90 divided by 4, which will be equal to 22.5. Right? Now, if you had not revalued the asset, what would have been the depreciation? It would have been 20. Now, because you revalued the asset, the depreciation is 22.5. This 2.5 is excess depreciation. This depreciation has resulted because of revaluation. So the company has an option to transfer such excess depreciation from revaluation surplus to retained earnings. And this is optional. That means if the company chooses to do this, then only you have to do this in exams. It is not compulsory. But when the asset is disposed or the life is over, that time compulsorily you have to transfer all the surplus balance to retained earnings. Please remember that point. Okay. Chalo. So this was measurement. Now we move on towards the component accounting. Now what is the meaning of component accounting? Let's say you have a PP. Now a single PP can have multiple components. Let's say you have a PP in the name of aircraft. So aircraft can have certain engines which has a life of only 5 years, and the other part of aircrafts might have a life of 10 years. So that means under one single asset you have multiple components with different lives. So if you have a particular asset which has multiple components, you need to depreciate that component separately. Let's say, for example, the aircraft costed you 100 lakhs. Out of this, 20 lakhs was for engine and 80 lakhs for the other parts. So these 20 lakhs will be depreciated over a period of 5 years. This 80 lakhs has to be depreciated over a period of 10 years. The first point. Second point, if you have multiple components with equal life, let's say engine also had a life of 10 years, other parts also had a life of 10 years, then you need not depreciate separately. This is the second point. The third point is, if you replace any part, let's say you replace the engine after 3 years. So you will add the new value of engine, you will add the new cost of engine, right? But you, at the same time, you also deduct the carrying amount of old engine because you had replaced that engine. So here it is written in this third part. When significant part is replaced, old carrying amount of replaced part will be derecognized and the new carrying amount will be recognized. So this is the third point which you need to remember. Okay, let's move on towards the next point. Subsequent cost incurred. Once you buy the PP, let's say after a couple of years you incur certain expense in respect of that PP only. So what is to be done with that particular expenses? So if you incur any repairs or day-to-day expenses, it will be transferred to profit and loss. If you replace any major part, we already discussed, we will apply component accounting. That is, we will add the new carrying amount, will be deduct the old carrying amount. Next is, what if we conduct any major inspection and overhaul? What is the meaning of this point? Let's try to understand. Let's say, for example, government has told you that if you have an airplane which has a life of 20 years, you need to do an inspection and you need to get a certificate after every 5 years, right? So we know that we have to incur such inspection expense after every 5 years. But what we are going to discuss here is, on day one, will we conduct the inspection? The answer is no. Why? Because we would have received the asset after inspection only. So on day one, you need not inspect the asset again because inspection would have already been done for the new asset. That means if you acquire a certain asset with a life of 20 years, and if you are, let's say, paying 100 lakh rupees, That means you have paid a certain amount of money for inspection as well on the day one. So there is an inherent assumption that in the cost of day one, certain cost of inspection would have also been included. So let's say the cost of inspection in general is 15 lakhs. So these 15 lakhs will be depreciated over a period of 5 years, because after every 5 years you need to inspect again, and the remaining 85 lakhs will be depreciated over a period of 20 years. That means even if it is not mentioned that inspection is done on day one, you have to inherently assume that in the cost of PP, in the day one's cost of PP, the cost of inspection is already included, and you need to depreciate that inspection part separate. That means for inspection we will apply component accounting. Now let's read the given note below. Note, in initial cost of PP, the cost of inspection is already included. Therefore, depreciate that cost separately by applying component accounting. When further inspection cost is carried out, the cost of new inspection is recognized in the carrying amount of PP, and the remaining carrying amount of the previous inspection is de-recognized if any. Right? This was the fifth point which we discussed. Next point is land and building. If you have a land and building, the standard says you need to account for it separately, because land generally has a life which is infinite, so it is not depreciated. So land will have an infinite life, not depreciable. In case certain land might have a finite useful life, so you might depreciate it, but building always have a finite life, you will depreciate it. Next point is depreciation. Now in case of depreciation, what are the methods which you can adopt? It can be SLM, WDV or units of production. One clarification is given that depreciation based on revenue earned is inappropriate. Let's say for example you used a machinery, you generated an output of 10,000 units, but in the current year none of the units were sold. So you are saying that because my revenue in the current year was zero, my depreciation charge will be zero. That is wrong. Why? The assets depreciation means the wear and tear of the asset. As soon as you use the asset, the life is reduced, right? The capacity is reduced. That means because you have used the asset has to be depreciated irrespective whether that units have been sold or not. Next point is depreciation period. Commencement and cessation. When will you commence the depreciation? It will be commenced when the asset is available for you. And what about cessation? It will be cessated at the earlier of when it is classified as held for sale as per 105, or when the asset is de-recognized, that is the life is over or it is sold. What will be the depreciation amount? Cost minus residual value. You will depreciate maximum to the extent of residual value. That is what it is trying to say here. Next is residual value. What is the meaning of residual value? It means the value of the asset at the end of its useful life. What is the meaning of useful life? The period over which you will receive any benefits from the asset. Next point is annual review as per IND AS 8. That means if there is any change in the method of depreciation, residual value, useful life, you need to review it annually. If there is any change, it will be accounted as a change in accounting estimate. That means you have to do it prospective accounting, do a prospective accounting here. Next point is impairment, which is discussed in IND AS 36, need not study here. Next point is de-recognition. What is the meaning of de-recognition? Once the asset is used, once the life is over, or if it is sold, you will de-recognize the asset. That means the asset will be moved out of your books. So once it is done, you will de-recognize it. The point which you need to remember is if you have sold the asset and if you have a certain gain on the sale of asset, let's say for example, on the date of sale, the carrying amount was 10 lakhs, you sold it for 11 lakhs, you have a gain of 1 lakh rupees. Such gain will be transferred to other income and not revenue from operations. It will be a revenue, but it will not be a revenue from operations. It will be other income, right? And if you sold it at a loss, then it will be other expenses. The next important point which you need to remember is if there is any changes in the estimate of decommissioning, restoration or similar liabilities. We just discussed that there can be a decommissioning liability which we will record at present value, right? So let's say there is any change in the estimate of decommissioning. Let's say we thought we will have to incur 10 lakhs at the end of 10 years. Now, after 2 years, we came to know that we don't have to incur 10 lakhs. We have to incur 12 lakhs at the end of 10th year, right? So how will such change in the decommissioning be accounted for? So in that case, first of all, you need to see whether the asset is being carried at cost model or whether the asset is being carried at revaluation model. If the asset is being carried at cost model, you will adjust such change from cost of the asset. That means if your provision of decommissioning increasing, so let's say there is an increase in provision. So what entry you will pass? You will pass because the provision is increasing. So you will credit the provision and we will adjust from cost of asset, that is debit the asset. Because you have debited the PP, the carrying amount of PP will increase That means the depreciation will also change prospectively. Let's say in this circumstance, there was a decrease in provision, so the entry will be reversed. Provision will be debited and you will credit PPE. Let's say if the asset was being carried at revaluation model, if there is any increase in provision, what you need to do? In this case, you need to adjust such increase or decrease from revaluation gain or revaluation loss. Let's say there is an increase in provision. That means your provision will be credited. So what will you debit? Debit all expenses and losses. That means revaluation loss will be debited. Let's say, for example, there is a decrease in provision. So in this case, provision will be debited and a corresponding credit will be created towards revaluation gain, because gains in case of nominal account, debit all expenses and losses, credit all incomes and gains. So this will be the following entry, right? So this is what we discussed. This is given in the chart below as well, right? So along with this, we are able to complete our 100% concept revision of IND AS 16 as well. Now, without wasting any further time, we will also revise IND AS 38, because there are very much similar points in IND AS 38 and IND AS 16. So quickly we will revise this IND AS as well. IND AS 38, the name is intangible asset. The first point which we need to discuss here is definition. What is the definition of intangible asset? It is identifiable, non-monetary, without physical substance, held for use. What is the meaning of identifiable? An asset will be identifiable if it meets any of the following condition. If it can be sold separately, or if it arises from a legal contract. If it arises from a legal contract. If any of the two conditions are met, the asset will be treated as identifiable, right? If you can sell that particular intangible separately, it is not necessary to sell it, but if it has a capacity to be sold separately, identifiable. Or if it arises from a legal contract, it is identifiable. So give us an example of this. Let's say goodwill. If goodwill is self-generated, you must have heard that we never record it. Why? Because it cannot be sold separately and because it has not arisen from a legal contract. But if the goodwill is purchased, we do record it. Why? In case of purchased goodwill, it cannot be sold separately, but definitely it has arisen from a legal contract. That is why purchased goodwill is recorded and self-generated goodwill is never recognized, right? Identifiable, non-monetary. Non-monetary means any asset which cannot be realized in fixed and determinable amounts. Let's say you record a intangible at 10 crores. So that does not mean that you will be able to recover 10 crores by selling it, right? So if it is not realizable into currency in fixed and determinable amounts, it is a non-monetary asset. Sir, what is the example of monetary asset? Trade receivable. If it is shown at 1 CR, that means you are going to receive 1 CR from a party, right? Of course, we know what is the meaning of without physical substance and held for use. Now, one guidance is given. What if any asset has both tangible and intangible elements? What is to be done in that case? In that case, we should assess which is the more significant element. Examples are given here. Recognition criteria, it is same like PP, right? We move on towards measurement. Measurement, it is very much similar to PP. We will only discuss the differential points, right? For example, in case of initial, it will always be at cost. In case of if the asset is purchased, everything is same like PP except there is no decommissioning because there is no substance in intangible asset. Exchange, it is same. Government guarantee, it is same. What if you acquire any asset in business combination? There are 4 points which you need to remember. Please listen to me carefully. First of all, if you acquire any intangible in business combination, you will record that intangible at fair value. First point. Second point, if let's say you pay a PC of 15 crores, but you acquire net asset of only 13 crores. That means extra 2 CR you have paid for goodwill. Such goodwill will be recorded separately. Second point. Third point, if any intangible is not recorded in the books of selling company because it was self-generated for them, but because you are paying some money for that asset and you are acquiring it, that intangible becomes purchased for you. So can you record any intangible which was not there in the books of selling company, but because it is purchased for you, recording it? The answer is yes. If it was not there in the books of selling company, still you can record it because for you it is not self-generated, for you it is purchased. And the fourth point, if two intangible assets meet the definition together, so the purchasing company will record those two intangible assets together and not separately, right? Done. Now, fifth point, internally generated intangible asset. What if you generate an intangible asset internally? So there are two bifurcations here. First, in case of internally generated goodwill, you will not record it. In case of other intangible assets, you will classify it into two phases. One is research phase, one is development phase. The amount which is incurred in research phase will be transferred to profit and loss. The amount which is incurred in development phase will be capitalized. But how do we know that the development phase has begun? So if all these 6 conditions are met, we can say that the development phase has begun. What are the 6 conditions? First, there should be technical feasibility of completion. Next, there should be intention to complete. Third, there should be ability to use or sell the asset. Fourth, how the intangible will generate future economic benefits. Fifth, availability of adequate resources. And sixth, ability to reliably measure the expenditure. Sir, how do we remember these 6 points? 2 relates to completion. 2 points are recognition criteria, FEBs and expenditure measurable reliably, and the other 2 you can remember, ability and availability, right? This is how you can remember the 6 points. Always remember, once you meet all the 6 conditions, after that only development phase can begin. And once the development phase has begun, you will capitalize all the cost incurred, but we will not capitalize all cost. We will only capitalize direct expenses, directly attributable expenses in the development phase, right? Now, there are few other important points which are related to internally generated intangible asset. First, what if it is difficult to distinguish between a research and development phase? You will treat the whole phase as research phase, right? Because if it is difficult for you to distinguish, that means the development phase has not begun. Next, following items, if they are internally generated, they will never be classified as intangible. Brands, customer list, titles, mastheads. Next, if the research phase was acquired in business combination, see, you can do your own research. The other option is you can acquire someone else's research project. So if you acquire any third party research project in business combination, such acquired research project will be capitalized. Always remember. Okay. Thank you so much, Vinayak. Thank you so much. Let's move on. That was initial measurement. Now we move on towards subsequent measurement. In case of subsequent measurement, same like PP, we have 2 models, cost and revaluation. The only difference is, unlike PP, if you want to use reevaluation model here, the fair value should be of an active market. Active market means a market where the intangible is purchased and sold. What we say, any intangible which can be purchased and sold in a active market means it is regularly traded. In a market where the intangible is regularly purchased and sold, that is an active market. So if you have a fair value of active market, then only in that case you can follow a revaluation model. This was not the condition in PPE, right? Rest all the points are same. Frequency, treatment of accumulated amortization. Here it should be amortization, right? The next is, it should be applied to entire class of asset. If you choose any model, it should be applied to entire class. There is one exception here. The exception is if there is no active market for an intangible in a class. Let's say in a class you have 4 intangible. You don't have an active market fair value of 1 intangible asset. For that particular asset for which you don't have an active market's fair value, for that particular intangible you can follow cost, but for the remaining asset in the class you can follow revaluation, right? But if for all the assets in a class you had an active market fair value, then in that case you cannot argue that I want to follow cost for certain assets and revaluation for other assets. That is not the option possible. That is not the option which is available. So let's read this out. If no active market exists for an intangible asset in a class, then that particular asset will be carried at cost model, and remaining intangible in that class can be carried at revaluation model, right? The 4th point, treatment of revaluation gain loss is same, and the 5th point is also same. Now we move on towards the other points. Subsequent cost incurred. In this case, in case of intangible, generally any subsequent cost incurred do not result in any future economic benefit, therefore transfer to P&L. 5th point, expenditure incurred but no intangible asset. I had always told you to remember this list. In case of these expenses, always, irrespective of what the question says, irrespective of what the company estimates, these following expenses will always be transferred to profit and loss and will be never be recognized as an intangible asset. The expenses are research cost, startup cost, training cost, advertisement and promotional activities cost, and relocation cost, right? Next point is amortization. It is same like PP, except in PP we discussed that amortization based on revenue is inappropriate. But there is a rare case in an intangible asset where it can be appropriate. Let's say, for example, you have a toll collection right. For how many years? The years are not mentioned. But the government has told you that you can collect toll up to a specific revenue. That means you can collect toll up to 100 crore rupees. That means here the life of the toll is dependent on the revenue. Let's say you are able to collect, let's say you are able to collect 20 crores in the first year. So that means 1/5 of your license right has expired, right? So where the life of the intangible is dependent on revenue earned, in that case, amortization based on revenue is appropriate, right? Rest cases are same like PPE. Then residual value. In case of intangible, there is no physical substance. Therefore, the residual value is assumed to be 0. But unless if there is a commitment by the third party to pay you something for that intangible, or if there is an active market for the intangible, and it is probable that such market will exist at the end of useful life, in this case, there can be some residual value. Next point is useful life. In case of intangible, if the useful life is infinite, you will not depreciate, you will not amortize it. Of course, if you have studied IND AS 36, you might know that it is tested for impairment annually in case of infinite useful life. But if the useful life is finite, you will amortize it. There is some guidance given on useful life. What is the guidance? It is related to renewal period. If there is any renewal period in the intangible, so should we include that renewal period in the life of intangible asset? If you feel that, if there is an evidence that you will renew the intangible at the end of the useful life and any conditions will be satisfied and the cost of renewal is insignificant, so in that case the renewal period will also be included in the life of the intangible. Let's say you have a license of 15 years and also there is a renewal period of 5 years. So should we consider the life as 20 years or 15 years? So you will consider as 20 years only if these three conditions are met, right? The next point is annual review as per IND AS 8. Again, amortization method, residual value, useful life should be reviewed as per IND AS 8. Change in accounting estimate, impairment will be done as per 36, and derecognition is same like PPE. So this completes our revision of 3 important IND AS, that is IND AS 1, IND AS 16 and IND AS 38 in complete English. So if you liked this revision video, do put in your comments, do let me know whether you found it helpful. If you found it helpful, I will try to make such videos in 100% English for the other IND ASs as well, but that will only be done if you found it helpful. And how will I come to know? Through your comments. So do put in your comments in the comment section so that I can know regarding the same. Okay, so thank you so much everyone for joining us to revise these 3 IND ASs, and hope to see you soon in some other helpful sessions. So thank you so much everyone. Bye bye everyone, take care. See you all. Bye bye. Thank you so much, Vinod. Thank you, Lekhi. Thank you, Chandu. Bye bye, everyone. Take care. See you all. Bye bye.